All right, welcome students to today's Explainer. I am Professor Wealth, and our mission today is crystal clear. We're going to master the real numbers, strip away all that confusing financial jargon, and learn the actual practical logic behind building long-term wealth. Every single day we make decisions about our money, what to spend, what to save, what to invest in, but so rarely do we sit down, pull out our notebooks, and actually look at the math behind those choices. Well, today we change that. Class is officially in session, and we're starting from the ground up to understand exactly how income, assets, and debt truly interact in the real world. And, before we jump into the first lesson, I just have to take a second to acknowledge the sheer size of our classroom today. 50,000. There are over 50,000 of us on this journey right now. That is a massive community of focused learners who have just decided to stop guessing and start taking total control of their income, their assets, and their financial futures simply by doing the math. It's an absolutely incredible group dedicated to breaking down the everyday decisions that shape our lives, and I'm so thrilled you're a part of it. But before we get into the equations, let's establish a ground rule for this classroom. I am not standing on some mountain shouting down at you. We're figuring this out together. Seriously, I am walking this exact same road right alongside you. Behind every single lesson we cover in this explainer, there are long nights of research, scripts rewritten until the math is undeniably accurate, and a deep, personal dedication to undoing bad financial habits. I'm learning and growing as I go, just like you. We are absolutely in this together. Okay, let's dive into this. Here is our syllabus for today's session. We are breaking this course into 3 core modules. First, the psychology of money. Second, understanding debt and wealth. And third, the math of investing. Starting right off with Module 1, the psychology of money, where we'll unpack the mindset through a Gen X case study. So before we can ever hope to tackle the hard math, we absolutely have to unpack the mindset. Your brain is essentially the engine of your wealth. And if your internal financial logic is flawed, the numbers on your spreadsheet simply aren't going to matter. So let me pose a question to the class. Why do Gen Xers treat debt like a trap and stockpile cash like doomsday is literally next week? It's a fascinating paradox. We have this entire generation born roughly between 1965 and 1980 that is deeply suspicious of the whole concept of financial security, yet incredibly allergic to credit card debt. Why is that? What makes an entire demographic tick financially? And what can we learn from their anxieties? Well, if we examine the case study, Gen X money habits look deliberately contradictory. They are fiercely loyal to their savings rate. They are completely suspicious of anything labeled as security, like a standard corporate pension or a totally safe career path. They avoid credit card debt like the plague, yet, and here's the real kicker, they are entirely willing to splurge on the one thing no recession can repossess, which is life experiences. Plus, they are the generation of DIY investing and quietly building backup side hustle income. Essentially, this is a generation that trusts absolutely nothing but prepares for absolutely everything. Now, what's really interesting about this slide is the science behind this behavior. Back in 1986, psychologists Julie Norham and Nancy Canner defined a concept called defensive pessimism. This is the psychological strategy of actively anticipating negative outcomes in order to manage your anxiety and prepare for the absolute worst-case scenario. So that Gen X scarcity mindset isn't just paranoia, right? It's a highly structured coping mechanism. When you mentally expect the market to crash or the job to disappear, stockpiling a massive emergency fund and building a side hustle is frankly the most logical, rational thing you can do. But it actually goes even deeper into behavioral finance. Behavioral finance shows us that the pain of losing a dollar is psychologically twice as powerful as the joy of gaining one. We call this loss aversion. Combine that with mental accounting, which is where we treat money differently based on where it came from or what it's for, and you suddenly understand why people severely overthink their 401k, hate traditional financial advice, and treat debt like a literal trap unless they can map out the exact path to completion. It's all about a deeply ingrained, almost primal need to protect against loss. Let's move to Module 2 and see how this builds. Understanding debt and wealth. It's time to leave the psychology behind for a minute and dig into the hard numbers. I want you to really think about this statement. If you don't understand debt, you don't understand wealth. Far too many people out there think building wealth is strictly about making more money or, picking that one magical stock. But mastering your liabilities is half the equation. You literally cannot build a massive financial fortress on a crumbling foundation of toxic debt. As students of wealth, we have to show our work and confront the math on the money we owe to truly unlock our long-term potential. Let's apply this logic to a mortgage. Culturally, people always want to wait for interest rates to drop. But let's run the actual numbers here. Waiting 3 years for a 1% rate drop might save you, say, $200 a month, but in doing so, you miss out on $40,000 in home equity and compounding appreciation in the meantime. The math proves that trying to time the debt market is a costly myth. We have got to rely on equations, not our emotions. Module 3, the math of investing. Now we are getting into the actual tools and assets used to build your wealth engine. And this brilliantly illustrates what happens next. You've tackled your debt, now let's build the engine. Everyone wants a flashy, high-yield fund that sounds great at a dinner party, right? But factor in a standard 1% management fee and the tax drag, and over 30 years, that exciting fund loses hundreds of thousands of dollars to Wall Street compared to just a boring, low-cost S&P 500 index fund. It's not about what sounds exciting, it's about what the compound interest formula dictates over decades. In the world of wealth logic, boring is highly profitable. And speaking of index funds and broad market investing, here is a fascinating little fact that completely surprises most of my students. You probably already own a piece of Elon Musk's SpaceX without even knowing it. Because of how modern institutional investing works, your standard 401k or your broad mutual funds are constantly buying into the broader economy, touching vast networks of companies and private equity avenues long before you actively decide to hit buy on a specific stock. It just goes to show how powerful, hidden, and wide-reaching basic automated investing truly is. Your money is out there working in places you haven't even realized. So the crucial point is that stocks and index funds are only part of the story. Take a look at this idea. If you don't understand bonds, you don't understand money. While equities give your portfolio growth, bonds provide the structural stability that makes the entire system of global finance work. They act as the shock absorbers for your wealth. Understanding how yields, interest rates, and bond prices interact is a fundamental, undeniable piece of everyday wealth building that you just cannot afford to ignore. Okay, so how do we put all this theory into practice? Consider this your absolute ultimate prerequisite for wealth. It all comes down to a simple two-step process. Step 1, you get paid. Step 2, you make this critical money decision. The exact moment your paycheck hits your account, you must direct those funds with intention. Automate your savings, fund your boring index investments, and attack your debt before your defensive pessimism or your desire to splurge takes over. Pay yourself first. That is the required action step if you want the math to work in your favor. Which leads me to your final exam question for today's explainer. The math is undeniable. We've seen the numbers on debt and index funds, and we've unpacked the psychology holding us back. But will you take action today to rewrite your wealth logic? Having the knowledge written down in your notebook just isn't enough. You have to actively undo your bad financial habits and apply these lessons in the real world starting today. Class dismissed, students, but your real work starts right now. I'll see you in the next session.